Hello, everyone. This is Dr. Gregory, and we are in ACC4620, Auditing and Assurance 2. We're now going to start discussing Chapter 11, which has to do with auditing inventory, goods and services, accounts payable, and related expenses. So let's just go over really quickly the acquisition and payment cycle that we have. We start out. Some companies use a purchase requisition, which is an internal request in the company to purchase something. And once that internal request is approved, then a purchase order is created, sometimes by the accounting department or a subset of the accounting department, such as procurement. It's also approved. The purchase order goes out to purchase the goods and services. We receive the goods and services into a company, and usually there is a receiving report that's signed off by someone in the shipping department who's received it. The documents then go to probably the finance accounting department, where they are put together and reviewed and approved for payment. And then the last step is the preparing of the cash payment. Now, when we think about this, again, we have a number of accounts that are affected: cash, accounts payable, inventory, especially if you're a retail or manufacturing company, the cost of goods sold, the expense accounts. You may have overhead accounts if you are a manufacturing company. We also now are learning to incorporate automated services such as blockchain, which we've gone over before, which is the electronic transfer and approval of the documentation. Let's look at the management's 5 assertions when it comes to inventory. We want to know that the inventory exists and it's on the balance sheet as of the balance sheet date. The inventory transactions are complete and they're all included up to the end of the period. The company has title or rights to that inventory at some point in time. Inventory is the true value for raw materials, as well as work in process and finished goods. And finally, inventory is being properly classified, valued, and disclosed, and included in the notes to the financial statement. Just like inventory, we want to make sure that we have the management's assurance or assertions regarding accounts payable. The AP balances exist on the balance sheet at the balance sheet date. All of the accounts transactions have been included in the financial reports up to the end of the period. The company owes and has an obligation to pay for those liabilities. Accounts payable is the true value of the payable, and accounts payable is properly classified and disclosed in the financial report. Now, there's, again, a number of inherent fraud and control risks when we're thinking about inventory and accounts payable. This isn't all of them. So again, always look to your text for more complete information. Under the inherent risk, the nature and diversity of inventory items places the inventory account at risk. You have items that are sitting, probably if you are a manufacturing company, in 3 different buckets. So as an auditor, you have to look in all of those buckets for the inventory. There's a high level of transactions in inventory, and those transactions are both internal, as we're moving, or as the company is moving from the raw materials to the work in progress and the finished goods, but also the external transactions that are going on, which is the purchasing and paying of the inventory. A client, under GAAP, there are multiple inventory valuation methods, and there are different ways that inventory is counted, either under the periodic or the perpetual system. So you can see there could be loss, theft at multiple stages and locations. The fraud risk could be lost due to unusual shrinkage. There will always be some amount of shrinkage. It comes with the territory. But if that shrinkage starts to pick up a pattern or is unusual in nature, that could be a risk of fraud. The company could be understating accounts payable to improve the financial results. There might be phantom invoices and payables or other employee schemes going on. There could be a misclassification of expenses as assets. For example, routine repair expenses should be an expense and not capitalized under the asset unless it extends the useful life or value of that piece of equipment or that asset. You might have manual adjustments going on. And you might see a misuse of the travel and expense accounts as company expenses. Under the control risks, management or employees could be understating the AP to improve financial results. There may be a lack of policies, procedures, and oversight. There could be other accounts, expenses, discounts and returns, factory overhead that might be subject to manipulation that are part of the inventory and accounts payable. We could have poor training resulting in excess waste of inventory. And there might be a lack of oversight as to watching for the possibility of obsolete inventory in the system. So what are some of those internal controls that are relevant to acquisition and payments? Again, all purchases are authorized. Timely, accurate, complete inventory. Inventory is received and verified, and if damaged, returned. And when we are looking at inventory, at the accounts payable side, we want to do a three-way match for payment and cash disbursement. And that three-way payment is making sure there's a purchase order, purchase requisition, purchase order, receiving report, and invoice that all ties together. We might have internal controls relevant to which type of inventory system we're using to count our inventory. So employees count the inventory, management reviews the inventory. There's quality control testing to make sure that the inventory isn't gone into obsolescence. We monitor contract suppliers and contract supplier contracts themselves. When we're looking at the use of analytical procedures for inventory and accounts payable, we have a number of different types of ratios we could be looking at. And here are just a couple of them. There's more in the text in Exhibit 11-6, but this could give you some information as to comparing these different ratios to benchmark of the industry and see where the company falls. Also, you can review trend analysis in both balance sheet and income statement, but make sure that when you are looking at that trend analysis, you are cognizant of any changes between prior years and the current year regarding the type of inventory that's being purchased. Maybe there's new contracts out there. There could be cyclical issues or supply chain issues that we have to think about. So trend analysis is great, but always be cognizant of conditions that may skew your data results. When we're trying to obtain evidence, we want to look both entity-wide as well as transaction testing. We want to make sure, again, purchases are authorized, payments for goods received only. We want that receiving report in there. We want to make sure that payments are the appropriate amount and in the correct period, the matching principle. And we want to make sure there are no duplicate payments going around. So we might be looking at inquiry of personnel who are performing the jobs. We might want to observe them performing their job. We're going to do some examination and recalculating of the documents and doing some tracing. We want to look at the timing of recording. Lags in the recording could indicate some problems on the horizon. And we want to ensure that proper authorization through policies and processes are established. Some, not all of the suggested substantive tests within the acquisition and the payment process look at attending the inventory and observing the inventory being conducted. Most of the time, you're not going to be able to do that. So instead, what you may do is perform a test of inventory items and compare your test counts to the client records. You may want to sample purchases and trace or vouch the item to the general ledger or the general ledger back to the source documents. You probably want to make sure that if the company has proper receiving reports, that they're pre-numbered and you don't have any that are out of sequence unless they have been properly voided, and you can find those voids. You'll definitely do sampling of the accounts payable documents and trace and vouch that information. And you're going to finally review the documentation in the disclosures and perform some inquiries. So if these controls or these substantive tests for the controls aren't working, inventory may not be in existence. It may be phantom inventory, beefing up that asset when that asset doesn't exist. Purchases may have been recorded in a different period. So you want to look a few days after the cutoff and ensure that purchases in the future period are being recorded in the future period and not brought back to a prior period in order to make the inventory appear better. You may want to look at adjustments and reversals of adjustments at the cutoff date and after the cutoff date. You want to recalculate your work to make sure that the payments were calculated correctly, that the items were matched correctly. What was on the receiving report was what was on the invoice, same items. You may need to take a look at any returned items as well. And finally, you want to make sure that you've got the disclosures in there, because inaccurate disclosures may lead to an inaccurate compliance of standards. We also want to take a look at how we're going to set up some, not all, substantive tests regarding inventory and cost of goods sold, especially under manufacturing companies. Retail companies are a bit easier. You purchase the pair of jeans in its finished form, and then you resell that same pair of jeans. You're not doing anything to the pair of jeans, but bringing it in under one cost and selling it for another cost. Manufacturing, you've got those 3 different inventory accounts. You've got raw materials inventory, which is the actual items that have been purchased. And then as those items go through into work in process out on the production floor, you're going to be moving some, not all, of the inventory into that production process. But at the same time, you're also going to be looking at costs involved with work in process, such as the cost of the labor, the cost of the overhead, the cost of the factory machinery. That's all got to be included in that. And then you've got to make sure that all those components are in there when you are moving your inventory out of work in process into finished goods, because it becomes part of the cost of goods sold when you are selling the product. So again, observing the inventory, looking at those receiving reports. What is the process for returns? Are goods on consignment? Or do you have inventory located in multiple locations? Perhaps you've got one warehouse that holds the raw material, and then as raw material moves over into the work in process, before it becomes part of the goods, it may be sitting in another warehouse ready for the production line. You'll also have finished goods inventory. Okay, I apologize for that. I told you that I have dogs and they wanted to greet you and let you know that they were around. So as we were talking about it, looking at those multiple locations to make sure that you've accounted for all that inventory. You want to review those vendor invoices and purchase contracts to make sure that the language is consistent and correct. If title in a contract goes to the client, we want to know when does title pass and make sure that we've tested for title passing. Also, we want to look at those contracts to make sure, is there any language of rights to return? We're going to trace that inventory through all 3 of those accounts. We're going to look for obsolete inventory items. So what you might want to do there is look at when the inventory was purchased and then look to see how much inventory is still on hand. If inventory was purchased at the beginning of the fiscal year and it hasn't moved through inventory, you might be dealing with an issue of having to ensure that that inventory has been adjusted and written down to its net realizable value. You want to take a look at any potential future purchase commitments to see what language is in there again. You want to review the inventory valuation methods and the classifications and make sure they are properly disclosed in the financial statements. Some other considerations you want to think about when we're auditing these accounts is making sure you look at the cutoff dates for the raw materials, work in progress, and finished good values. You want to make sure that there are all those associated expenses built into the cost of goods sold and that they've been properly applied. You might want to recalculate some of them. Review for unusual transactions in the returns and allowances account, as well as warranty accounts. If you're starting to see a very high number of transactions in the warranty accounts, there could be something with the quality of the product that is going on. You want to review long-term contracts for inventory purchases for agreed costs, rights of returns. You want to recalculate obsolete and damaged write-downs to make sure that they're valuing up at the net realizable value, and then Review the backup paperwork for those adjustments for rationale. Why are they considering those obsolete? Test, recalculate, and review the cost systems that the company has in place. They may be having activity-based costing in place. You want to take a look at that. How old is that activity-based costing system that they set up? If it's really old, probably want to suggest that they update them. We know that they're very expensive to update, but you don't want to have them rely on old valuations of their cost systems. Test that perpetual inventory system. That's very important. We want to make sure that that system, that software, is working properly. So in summary, we took a quick look at the acquisition and payment cycle. We looked at the management's assertions. We looked at the inherent fraud and control risks. We looked at internal controls that are relevant to these cycles. We talked a little bit, not much, about analytical procedures that you can use, how to obtain the evidence, and some substantive testing suggestions for both acquisition and payment process, as well as the inventory and the cost of goods, and just a reminder about some other considerations. Again, always be sure you're reading the full chapter. I'm just giving you the highlights, and so you need to go back and review the full chapter to understand it. And if you have any questions, please let me know, and I will see you in the classroom.